Hello, this is Ashley McHugh from InsuranceNewsNet, and I will be the administrator for today's webinar, How to Overcome Market Turmoil and Make 2023 Your Best Year Ever. Moderating the webinar is Paul Feldman, InsuranceNewsNet President and Publisher. Our guest today is Tom Hegna. Tom is an economist, author, and retirement expert. He has delivered over 5,000 seminars on his signature Paychecks and Playchecks retirement approach. He is known for his annual December economic commentary in which he looks forward to the coming year. In his December 2021 commentary, he advised viewers to lock in their bubble wealth in anticipation of a down market. Please ask any questions you may have in the questions pane during our discussion, and we will get to as many as we can at the end. And with that, I'll turn it over to Paul.
Hello, everyone. I'm Paul Feldman, president founder of Insurance NewsNet. And today you're in for a very special presentation with literally one of my favorite people in the industry, Tom Hegna. I've known Tom for many, many years. I've interviewed him numerous times for the magazine, for our website. He's spoken at my events. He's one of the greatest speakers I've seen in the industry. And he's never failed to amaze me with his work, his knowledge, and commitment to this industry. So today we're going to look at the current state of our economy, where we're going next year, because it's going to be a rough ride next year for some. But what we're really going to want to focus on and get to is where the great opportunity lies in our industry. So today's presentation is going to be fast-paced, just like a Tom Hegna normal presentation. It's just going to be a fire hydrant of ideas, facts, and statistics that you could literally use with clients today. So take notes, and everybody on this webinar is going to get a recording, so don't worry if you miss anything. Plus, if we have some time at the end, we're going to try to get some questions. If you do have questions as we go through this presentation, put in your email address, because most of them are anonymous. And that way we can try to respond to everybody. So I'm going to let Tom introduce himself, because he's accomplished so much. I can't keep up with this man. Plus, I did have a sneak peek at his 100+ slide presentation, and I do know that he's got it covered. So with that, Tom, please take it away.
Hey, thanks, Paul. And it's great. I'm grateful that you're all on today. I'm having some technical issues, so I'm actually doing this on my cell phone, and we're going to have Ashley flip the slides and stuff, but we're going to get through it. So a little background on me. I'm originally from a small town of Minnesota, went to college at North Dakota State University on an Army ROTC scholarship. I was commissioned in the military. I spent 6 years active duty, 16.5 years Army Reserve, retired as a lieutenant colonel in 2004. I spent about 30 years in the industry, 8 years with MetLife, 15 years with New York Life. I've been on my own since 2011. I've written 5 books. I have a PBS TV special, but I'm looking forward to the interview today, Paul.
Great.
So in 2022, what I did with my economic commentaries, I really strongly encouraged people, or 2021, I encouraged them to lock in their bubble wealth. That, if you think about it, back in November 2021, stocks were at the highest, your home was worth the most, Bitcoin was $68,000 a Bitcoin. But as Dr. Michael Finke and Dr. They did a podcast, and they were talking about bubble wealth. And they said you should lock in this bubble wealth. And so that's what I recommend, that people lock in their bubble wealth into real wealth. We're talking about inflation and skimpflation. What's skimpflation? Well, when you used to go to the store and get a 24 pack, and now it's a 16 pack and it's the same price, that's skimpflation. Interest rates were still low at that time. And I said, interest rates are going to have to go up, because you can't have inflation at 7% and have a 10-year and 30-year bond back down at 2 or 3%. It didn't make any sense. Interest rates had to go up. And then we talked about the massive government spending and the massive printing of money in quantitative easing. We talked about the supply shortages. And so, I think I was right on with my end of year prognostication, saying lock in that bubble wealth, because this can't continue.
So how did your predictions work?
I think they were right on, and people can go back, and every December, I have on YouTube, you can just type Tom Hegna economic commentary. For years, I said interest rates have to stay low as for as long as I could see. And then COVID hit, things changed. And that's why the 2022 is very different than any of the other ones in the past. And I think interest rates are going to continue to go pretty quickly.
I know you talk a lot about government debt.
Yeah.
Why is that such an issue that advisors need to be focused on and thinking about?
You know, if you take a look at this, we are now $31 trillion in debt. Every single one of you owes 247,000. So if you get those checks out, there's 1.7 trillion of credit card debt, over 1.2 trillion of that's student loan debt, and about almost 1.2 trillion of credit card debt. And the big scary one at the bottom, $172 trillion of unfunded obligation for Social Security, Medicaid, Medicare, government pensions, military pensions. I mean, what does this mean? It means taxes at some point are going to have to go up, and probably a lot. People don't know what $31 trillion is. So in Paychecks and Playchecks, I gave this simple analogy. If $1 equals 1 second, $1 million equals 11 and a half days. $1 billion equals 32 years. But $1 trillion equals 32,000 years. And 31 trillion, you're going to take 992,000 years at $1 equals 1 second. Now, why is this a problem? Well, if interest rates would stay at 1%, 1% interest on 31 trillion is $310 billion of interest. We can handle that. But at 5% interest, it's 1.5 trillion. And we know that the debt's not going to stay at 31 trillion. If it hits 50 trillion at 5% interest, that's $2.5 trillion. Now, to put that in perspective, the entire military budget for Army, Navy, Air Force, Marine, Space Force is $800 billion. The entire Social Security budget is $952 billion. You can see that at 1.5 trillion, that's almost the same as our entire defense spending and Social Security combined. It is totally it just can't happen. I mean, if that happens, the entire country is in huge problem. It's going to have a huge problem. And Fed Chair Powell knows this. So he is going to go higher with interest rates and for longer, because he's got to break inflation so that interest rates can come back down to 1 or 2%, and then we can handle it. But if interest rates and inflation stay high, there's no way this can continue. So he is
let me
going
ask
to
you one
raise
question,
rates.
Tom.
Yes.
One question. Where do you see interest rates going next year?
They have to go higher. They have to go higher because he's got to break inflation.
So inflation's the worst that we've seen, obviously, in the last 40 years. And
absolutely. World inflation is now over 10%. Our inflation, 7, 8%. But I'm going to show you in just a few more slides that it's really closer to 15%. Now, diesel fuel prices are a problem. Gas prices have come down a little. Diesel has come down a little, but diesel is still very expensive. And here's the problem. The easiest way to get gas prices down is to pump more oil. That's the fastest, easiest way. But this administration is not going to do that. So how can Jerome Powell lower gas prices? You know what he has to do? He has to take a sledgehammer to the economy and keep raising interest rates so 15 to 20 million people lose their jobs. They won't be out commuting. They won't be driving. He has to shrink your 401k and your stock portfolio so you don't feel wealthy and you don't go out shopping. That's how he has to do it. He has to reduce demand. The easiest way is to increase supply, but that's not going to happen. If you take a look, there's a diesel shortage in this country. Well, think about it. Everything you buy, all your food, your clothing, your furniture, it comes on a boat, a train, or a truck. They all use diesel. And so until these diesel prices come down significantly, you're not going to see a lot of lower prices in your grocery stores.
So the Fed's obviously been raising rates quickly. Where do you think this may go in the next year? So
the Fed has been raising rates the fastest. It's not just that they're raising rate, it's the pace of the raising of the rates. It's causing problems all around the country. But when the Fed chairman says there's going to be pain, I take him seriously. And when he says it's going to have to be higher for longer, I take him very seriously. See, the market thinks he's going to pause or pivot at 4.5% or 5%. I don't believe that's the case, all right? The 10-year bond now is a little bit below 4, but I think you're going to see that continue to go up. He has to keep raising rates. He's got to break inflation. The United Nations has called on the Fed to stop, because what's happening is the more he raises rates, the faster the dollar goes up. And the problem is that there's countries in South America, in Africa, these emerging market countries that put their debt into dollars. And when our dollar goes up, their debt goes up, even though they don't spend the money. So it's causing all kinds of problems. Now, the Fed has said they're going to keep raising rates until things start breaking. Well, FTX broke, and that was a little bit of an offshoot of this. But, in other years, Argentina or or Brazil or some of these countries have had serious problems. And that's a problem. So Paul Volcker was the Federal Reserve Chairman back in the 1980s. He had to raise rates to 20%. Now, some of you say, well, that was when inflation was 15%. This is shadow statistics. So they changed the way they calculated the CPI from back in 1980 to how they do it today. So shadow statistics put in all of today's data in the way that they did it in the 1980s. And look, our real inflation is probably over 15%. So when people think he's going to stop at 4.5% or 5%, I don't believe that to be the case. I believe he's going to have to raise rates significantly higher, and that's going to cause a problem for the market. Back in the 1980s, he crashed the home building so bad that the home builder sent complaint letters on 2x4s to his office. He's going to have to shrink your 401k. He's going to have to shrink your investment accounts. That's all that he can do to try to get inflation down if we don't increase the supply in many of these commodities. So 40% of all the money that has ever been printed in America has been printed in the last 2 years. Why is that important? Well, Milton Friedman, who's one of the top economists in the history of the world, said inflation is always and everywhere a monetary event. What does that mean? That means when you print money, it causes inflation. So we printed $5 trillion in the last 2 years. We have done government spending of about $5 trillion in the last 2 years. That's why inflation is raging. So that was the quantitative easing, that the printing of money. Now there's going to be quantitative tightening, which is basically the shredding of money. He's got to put $5 trillion through the shredder in the next few years. Well, when he printed money, market went straight up. What do you think is going to happen when he starts shredding all this money? And then there's this whole liquidity problem. The number one buyer of US government bonds for the last many years has been the Federal Reserve, and they're not buying them anymore. And there's a much lower liquidity, and that could be a problem for both the stock and the bond market.
So what's interesting is that both the stock market and the bond market's down this year, which is super rare. Where do you see the markets going?
This has been the worst year ever in the history of the market for the 60-40 portfolio. In fact, bonds are down more than stocks. It's just a crazy year. Back in 2016, I wrote this article. I said the 60-40 portfolio is dead, long live life insurance and annuities. And if you remember, bonds were only paying 1 or 2% at the time. And I said, it's crazy to put your money in bonds, because when interest rates go up, what happens to value of bonds? They go down. Why would you want to subject your portfolio to that? So I said, instead of bonds, replace your bonds with either life insurance or annuities, because they don't have the interest rate risk. And when interest rates go up, they don't go down, they go up. And so I wish people would have listened to that. And by the way, Forbes magazine signed up to follow my newsletter, and they even put it in Forbes magazine. So both stocks and bonds are down. This is one of the 3 worst years in the history of the stock market. There's only been 3 times when both stocks and bonds have been down, and this year is one of those years. People say, well, Tom, the market's only down, 15 or 20%. Yeah, well, these stocks are down over 80%. Snap, Twilio, DocuSign, Okta, Roku, Teladoc, Ring Video Doorbell, Carvana, AMC movie theaters. These stocks are down over 50%. And we're talking name brand stocks, Meta, Facebook, Nvidia, AMD, Netflix, PayPal. And these stocks are all down over 65%. So when you have clients who say, oh, I don't need annuities, my broker's been getting me 40% a year. Yeah, they're in these stocks. And those people are really hurting right now. Those people are the ones that are hurting the most. The chief economist of the International Monetary Fund said 2023, it's going to get worse before it gets better. And 2023 will feel like a recession to most people. Yeah, probably because we're going to be in one. Jamie Dimon says consumer spending is drying up. He says an economic disaster may be looming. Jeff Bezos of Amazon says batten down the hatches. Elon Musk, the world's richest person, makes a gloomy prediction about the economy. It's just not me. Bloomberg, they have a probability index on whether we're going to have a recession or not, 13 different indicators, and it points to 100% probability of a recession next year. Margin debt, that's when people borrow to invest. That's the most dangerous type of investing, and those numbers are near record highs. Credit card debt is through the roof because people can't afford inflation. They're putting things onto their credit card. I mean, we're talking some significant problems in the economies. For years, I said the reason the market keeps going up is because of TINA. TINA stands for There Is No Alternative. Well, guess what? Tina's dead because there are alternatives now. Annuity payout rates are incredible. There's real estate investment trusts that are paying 8, 9, 10%. There's preferred stocks that are paying 7, 8, 9%. There's busted convertibles that are paying 15, 20%. There are lots of alternatives in both stocks and bonds out there than just the stock market. And so I just don't see the stock market immediately rebounding. There will be a time when this market does pop and it will go higher, but it's not anytime soon that I can see.
So, we focus a lot on the US economy, and I think the global economy is really, really important for everybody. What are some observations you're seeing from around the world right now?
I mean, there's lots of places around the world. England had a problem when they did their little financial thing. They almost lost their whole pension system in England. Italy's had some issues. Japan has had some issues. But the one I'm really concerned is China. All right. China recently had their party Congress. They only have that every 5 years. And their leader, Xi Jinping, secured power. He got reelected for an unprecedented third term. And what he did was he immediately took power and got rid of all the moderates. You can see here that Hu Jintao, who sat on his left side, was a moderate, a previous leader, and he had him escorted out of the Congress, not in private, in front of everybody. He wanted everybody to see that they're out, he's in, the new sheriff's in town. He loaded up his entire cabinet with combat-ready generals. These are the hawks. These are the people that want to take Taiwan, okay? And now that's who's surrounding him. He said last year that he will not be successful if he does not reunify Taiwan and China. They think that they're one country. This year, he said it's closer than ever. And what scares me is that one of our own naval officers said that they could very well try to take Taiwan this year. And it doesn't help that we declared a chip war on China. So we're not letting any of these chip makers, to include Taiwan Semiconductor in Taiwan, we are refusing to let them sell the high-end chips to China. China needs that for their weapon system. They need that for their financial system. What's going to stop them from saying, oh, you're not going to let them sell us chips? Fine. We're going to take over the whole thing and not sell you any chips. I mean, I am concerned about this. Just keep your eye on China.
Okay, so we got a lot of doom and gloom here. Are there any silver linings for us out of all of this?
Absolutely, Paul. This is the opportunity of a lifetime. Your clients might be confused. They might be perplexed. They might feel like they're lost. But here's the deal. In times of uncertainty, people crave certainty. They crave certainty like a dying person in the desert craves water. They need what you do now more than anything.
Yeah, the opportunity of a lifetime is I love that. In times of uncertainty, people crave certainty. And I love one-liners, So let's dig a little deeper. Interest rates for annuities and payouts they've increased significantly over the past year.
Yeah,
what
so we take
opportunities does that give advisors?
So these are the highest payout rates that I have seen in a very, very, very long time. Now, the life only means you get paid for the rest of your life. If you die, the payments stop. Now, what some people think is that then the insurance company keeps my money. No, that's not how it works. If you pick life only and die, your money goes to the people who pick life only and live. That's why the payout rates are higher. But if you don't like that, you can pick life with cash refund. So, you get a check for the rest of your life. If you put in 100,000, it only pays you 20,000. Your family gets the other 80,000. But this is just one particular annuity. That's a single premium immediate annuity. But deferred income annuities, the payout rates are higher. Fixed indexed annuities have higher caps than they've ever had. So in a long time. So, I mean, all the products out there are built right now to help people with this situation. And it's all because of these mortality credits. People look at those payout rates, they say, well, that's too good to be true. No, it's not. This is based in math and science. The Financial Research Corporation of Boston, in this white paper that they wrote, where income annuities improve portfolio outcomes in retirement, here's what they said. Income annuities offer features others can't. High cash flow, uncorrelated to the market, retirement alpha in the form of mortality credits, which only life insurance companies can manufacture, longevity hedging, and liquidity features. I mean, think about it. Isn't that the exact definition of what somebody would want to have for their money right now? Now, I always knew what alpha was. Alpha is a measurement of outperformance. When a strategy, a trader, a portfolio manager outperforms the market over a period of time. For example, Will Danoff ran the Fidelity Contra Fund for decades, and he outperformed the S&P 500 all the time. And that outperformance he brought was called alpha. So I knew what alpha is. If you look at Morningstar, you can find out the alpha of any fund, but I'd never heard of retirement alpha. And the mortality credits in annuities give this alpha that you can't get from stocks or bonds or Bitcoin. So every check you get from an insurance company and an income annuity is composed of 3 parts. Part number 1 is principal. That's the orange box. Anybody can give that to you. Part number 2 is interest or investment gain. That's the gray box. Anybody can give that to you. But the secret sauce is the third ingredient. It's the mortality or longevity credits. I call them different things, but it's extra money from the risk pool the older you are and the longer you live. And what math and science says is if you have a retirement portfolio and you don't have any of these mortality credits in there, your portfolio will be suboptimal. It will be less than what it otherwise could or what it should be. Now, what you're looking at on the screen is the way it works in a SPIA, a DIA, or if you annuitize a contract. That's how it looks. But many advisors are using fixed index annuities or variable annuities with income riders, and that's how this works. Client puts in $100,000, they let it grow for a while, and then they turn on the income benefit. Well, first the interest comes out, that's taxable. Then the principal comes out, not taxable unless it's an IRA or 401k, but even if the account's zero, the checks continue for the rest of their life. What are paying the checks when there's no more money in the account? It's the mortality credits. So I still get people who say, Tom, I still don't know what these mortality credits are. So I got a simple story for you. Every year, 5 90-year-old ladies went on vacation. One year, one lady said, hey, let's each put $100 in this mason jar. We'll seal up the jar. And then next year, we're going to go on vacation. Those of us who are still alive, we'll open the jar and we'll split the money. They said, Helen, that is a great idea. So you got 5 90-year-old ladies. They each put $100 in the jar. They sealed up the jar. What do you think happened the next year? They forgot where they put the jar. No, I just made that one up. Unfortunately, one lady's died. So now 4 ladies open up the jar. They each get $125. Now that was a 25% rate of return in 12 months. I got this for you. How much of that money was invested in the stock market? 0. What interest rate did it earn? 0. How do they get paid 25% with no money in the market or no income? Because they mortality credits. So the ladies look at their brokerage account. This is a deal. I'm going to put it all back and seal it back up and do it again. So they decided to let it ride. The next year, more lady died. So now 3 ladies open up the jar. They each get $167. That was a 67 return in 2 years. No money, no interest rate. Why? Because they got paid mortality credits. Now, you're thinking, my clients don't want their money to disappear when they die. Do they have to have the money disappear when they die? No, they can do life with their spouse, joint life with their 5-year-old granddaughter. Things can pay for 100 years. All lifetime income annuity, these mortality credits. The older you are, the longer you live, and the fewer guarantees, the more the mortality credit paid. But what that does is it turns into that annuity to function in a portfolio, a AAA-rated bond, because it's guaranteed as long as you're coming. But with a AAA-rated yield, the payout rate is much higher than what you can get in CDs or bonds or money market funds with standard deviation. It does not fluctuate. It does interest rate risk. And so this is a tool that advisors, if you show this stuff to your clients, I promise you they're going to be excited about it.
So I've spoken to you so many times, and for you, it's not just about the math and science. It's also about retiring happy. How can annuities do that?
Yeah, well, that's what the research shows. One, the research shows your portfolio is likely to do better if you have an annuity in there. Number 2, you're going to be happier. And number 3, you might live longer. So let's take a look. Wall Street Journal puts it this way. The secret to a happier retirement is friends, neighbors, and a fixed annuity. And they found that the happiest people in retirement were those who were surrounded by friends, surrounded by families who had guaranteed paychecks every single month. Time Magazine found the same thing in Great Britain. Lifetime income stream, key to retirement happiness. Here at American College, how annuities increase happiness in retirement. A stable income is often the difference between living well and living in a state of perpetual worry. And this truth doesn't just because someone retires. Clients know how much income they will receive every month for life. They know what kind of housing and activities they can afford, allowing them to choose a lifestyle happiest. Not only that, but research now shows people annuities tend to live longer. This was the University of Chicago study. where they studied people who bought income versus people who didn't. And they found that the people who bought annuities lived longer than the people that didn't. And Freakonomics took this and pushed it out through social media. Research shows that people who buy annuities tend to live longer, and not just because of the kind of people that have money to buy annuities to start with. It's apparently that little extra incentive of the annuity payout that keeps people going. Well, I think I can live for a month. Yeah, I'm going to stick it to that insurance company one time, and they just live longer. The best article I've ever read was written by attorney Patrick Tricker, a journal for financial professionals. The title of the article was Annuities and Moral Hazard. Can longevity insurance increase longevity? Here's what he found. In the United States, a 65-year-old male who purchases a life annuity can expect about 20% longer than a 65-year-old male who does not. And the whole rest of the article explained why people who have guaranteed income tend to live longer. They don't have stress. They don't worry. And because they're being paid to live, guess what? Many of them choose to live differently. They watch what they eat. They exercise. They call the doctor when they're not feeling well. And all these dumb, stupid things tend to cause them to live longer. Now, I told you this was new research. There's nothing new about this. It's been around for thousands of years. The Roman Empire issued annuities. See, running out of money is not a new concern. Running out of money has been the number one concern of people ever since there's been people and there's been money. And the annuity guarantees that people will never, ever, ever run out of money. Now, many of you had to read a book in high school or college. It was called Sense and Sensibility. It was written by James 1811. Does anybody? She wrote about annuities back in 1811. Well, let me refresh your memory. You observe people always live forever when there's an annuity to be paid to them. The annuity is a serious business. It comes over and over every year, and there is no getting rid of it. She wrote that 1811.
So I know you base a lot of your training on research from the leading PhDs in the world. What are you seeing experts saying today?
Well, let's take a look. Dr. Michael Fink and Dr. Two of the smartest PhDs who study retirement. If the reason you save for retirement was to provide a secure lifestyle, there's no more efficient way to create lifetime than through an annuity. Purchasing an annuity with a portion of retirement savings can provide a higher potential for success, greater legacy wealth over long term, and increased capacity. Annuities allow a retiree at a level that would otherwise require a high failure if funded solely from an investment portfolio. Income annuities provide confidence, the freedom to spend and invest, as well as the opportunity to leave a legacy. Certainty provides confidence. This is one of the reasons that retirees who've incorporated income annuities into retirement planning report higher levels of satisfaction. Dr. Roger Ibsen, all right? He's the guy who invented the mountain charts. Whenever you see a stock mutual fund chart and they show that it goes up, he developed that chart, the mountain chart. He did a study where he compared a 60% stock, 40% bond portfolio to a 60% stock, 40% index portfolio. And you know what he found? That the indexed annuity portfolio up the bond portfolio for the last 40 years and is likely to do so for the next 40 years. So even if you just got your clients to move their bond portfolio into annuities, they would have done much better over the last 40 years. Then you've got BlackRock. BlackRock's got $7 trillion, something like that in the stock market. They're a stock market. They don't care about annuities, but look what they said. Fixed indexed annuities fit in the accumulation phase to help hire with confidence. Barclays is an annuity company. They're a stock. They do stocks, but they said fixed index annuities can outperform bonds. Ernst & Young, the top accounting firms in the world, they studied all different investment portfolios, 100% stock, 90% stock, 10% bond, 80-20, 70-30, 60-40, 50-50. Then they went through and then they added returns and income annuities, and guess what they found? The portfolio life insurance outperformed the investment-only approaches. Tommy's not making this stuff up. Even the Wall Street Journal says you should replace some of your bonds with annuities. Now, Paul, what's so important about this is I tell advisors all the time, if somebody says they don't do annuities, you change your mind. You've got a conflict of interest because you get paid and you don't get paid if they don't buy. You know that, they know that. So you've got to use these disinterested third-party references. See, I don't get paid whether they buy or not. Wall Street Journal doesn't get paid whether they buy or not. Dr. Michael Fink and Dr. Wade Fowler, American College, you use disinterested third-party information that can change their mind, okay? You're not going to change your mind. A man convinced against his will is of the same opinion. Use these powerful a distant third party.
So how does life insurance fit in to all of this? We've talked a lot
Well,
about.
you know, I have personally moved more of my personal wealth into cash value life insurance. I am convinced that taxes are going to have to go up a lot. So I've converted my 401k IRAs to Roth IRA. Most of those are in annuities. They will send me free income for the rest of my life. I've moved more of my personal life insurance, send me tax-free income for the rest of my life. And I just think having tax-free income for the rest of life is so important. So let me give you some examples of the certainty of life insurance. So back in the last market crash, back in 2009, the global financial crisis, I got a call from the American College. They said, Tom, we need you to write an article on why people buy life insurance in terrible markets like these. I wrote an article on why people buy life insurance in terrible markets like these. I said, there's always going to be three reasons why people buy life insurance. Number one, life insurance is a women's issue. What am I talking about? 70% of baby boomer women are going to become widows. And because they live longer than men, and they typically marry men that are older than themselves, they are going to live with the consequence, good or bad, of how much life insurance is on their spouse or on their partner. Now, am I saying it's not important for women to own life insurance? I'm not at all. Right now, women are more underinsured than men at a time when now over 50% of women are the breadwinners of their home. Women need more life insurance. Let me be clear on that. But 70% of the time, they're going to be the beneficiary of life insurance. So when we go talk to women about life insurance, yes, they need more life insurance, but you need to make sure there's adequate life insurance on their spouse or their partner. Many of them will be widows 15, 20 years. The second thing is life insurance is a tax issue. Here's a chart of the US marginal tax rate. You can see that for most of your parents' lives, it was over 70%. Back in the 1950s, after World War II, is at over 90%. You make $1 million, good. You can keep 100,000, but you got to send 900,000 to Uncle Sugar because they'll do a job with your money than you're going to do. Well, where are we now? We're somewhere around 38.9%. Well, I told you all the numbers. We're 31 trillion in debt. We have $170 trillion of unfunded obligation for Social Security, Medicare, Medicaid, government pensions, military pensions. I mean, taxes have to go up. This is not a Republican or Democrat issue. It's a math problem. We need a math party. We need a party that can actually add and subtract, because these parties apparently cannot do that. If there was a tax perfect plan, what would it look like? Well, the money you put in there would be tax deductible. Then it could grow tax deferred, and you could take it out tax free. Golly, that would be tax perfect. But you can't get all three. You can get 1 and 2, or you can get 2 or 3. Most of your clients pick 1 and 2. That's your IRA, your 401k, your profit sharing. Yes, you get a deduction. Yes, it grows tax deferred, but you get hammered with taxes when it comes out. All I'm saying is, shouldn't some people be in one? You don't get the deduction, but it grows tax of cash value life insurance. Here's a great way to talk to your clients about this, all right? What I would say is, I would ask the client, so do you have a 401k at work? Yeah. Does it have a match? How does the match work? Oh, if I put it the 4%, good, I would do that. That's 100% rate of return, do that. But anything above the match, I'm not going to put in a 401k. No way. I'm going to put that into cash value life insurance or Roth IRA, because we talk about tax diversification. You know, you talk about asset allocation and asset diversification. We need to be talking about tax diversification. And unfortunately, most Americans have most of their money in IRAs and 401ks. You know, Paul, I was talking to a guy the other day. He said, I got $1 million in my 401k. I said, that's great, but how much of that is yours? And he said, what do you mean? It's all mine. I said, it's not yours. No. I said, you got a partner, and you're not even the general partner. You're the partner. The general partner is the federal government, and they get to take out what they want first. You get whatever's left over. The truth is, you don't have any idea how much that is going to be when you retire, and how much of that is going to be yours. Life insurance is a trend. This is a story about Mr. and Mrs. Farmer. They have 500 acres valued at $8,000 an acre. Their son, John Jr., to take over the farm, and he needs the whole farm to make it work. His sister, Sally Smith, is a school teacher in Chicago. She has interest in the farm. He's entitled to half of the land. So right now, if the parents don't do anything, when they die, John Jr. will get 250 acres at $8,000 an acre, $2 million, and his sister will get 250 acres at $8,000 an acre, $2 million. But he needs the whole thing to make it work. So what are his choices? Well, if he's got $2 million in his pocket, he can hand it over to sister. Well, how many kids have $2 million in their pocket? He could go down to Mr. or Mrs. Bank, or he could take out a loan, or he could come to you and buy a second to die policy on mom and dad. Look, if he hands his sister $2 million and buys it for cash, he gets that land for $8,000 an acre. If he goes down to the bank and takes out a loan and pays it off over 15 years, it's going to cost him close to $13,000 an acre. Or he could buy a second to die life insurance policy, and he could get that land for about $2,800 an acre. I mean, Paul, life insurance, this is a way to treat children equitably, not equally. This works with farmers, ranchers, business owners, restaurant owners. When you have multiple businesses with little kids, some kids are in it, some kids aren't, the most efficient way to handle that situation is with life insurance.
And it keeps out of probate.
Yeah, I think that's it. Yep.
Okay, so we have one question thus far. Isn't corporate wealth the highest in 50 years?
Well, and there was a study on that. In fact, it was a Democrat who showed that a lot of the inflation was caused by increased profits at the corporate level. But you know, I'm a list, and so I say that can only last for a little while, because somebody else is going to come in there and underprice them. So I don't understand why gas prices in Phoenix, Arizona are still over $4 a gallon, when a lot of other places in the country it's under $3 a gallon. Something doesn't seem right to me. So I think there might be something there, but I don't think that's the only thing. But I do think some corporations, and you see it, any contractor, you get a plumber, an electrician, everybody's just they're adding prices. It's not necessarily that everything that they have has gone up. For a while it did, but now some of these things have gone down. Do you think the prices are coming down? I don't think so. Do you think wages are coming down anytime soon? Do you think rents are coming down? All of those things count towards this inflation number that Powell's got to fix. So I'm telling you, he is going to have to severely damage the economy, I believe, to get inflation down. And there's going to be a lot of pain out there. And I think this is the perfect time to be in this insurance business, because we offer certainty and guarantee in a time of uncertainty.
So this is a really great question, and something that was on my mind as we were going through this talk here. What about the central bank digital currency and the end of the US dollar? For me personally, I find this frightening, the amount of controls that a government can put on people. It's not getting a lot of media attention. It was, a press release came out the day before Thanksgiving in the afternoon about it, that they were testing it. And it seems like it's all in motion and there's nothing we can do about it.
Yeah, look, people have been concerned about another currency taking over the reserve currency status, because right, US dollar reserve currency for the world. And because we're the world's reserve currency, we can get away with a lot of stuff that no other countries do. And we can print money, we kind of stuff, because everything's priced in dollars. So I would say that's going to be a concern when you can actually see something that could take over the dollar. But it's not going to be the Russian ruble. It's not going to be the Chinese yuan. It's not going to be the euro. So I don't see it. And the digital currency, I think a lot of people would be skeptical to use a government digital currency. I can see them going to Bitcoin or something like that, because then that's totally tough. I don't know. It's going to be interesting to see how it plays out. And, Paul, thought my Facebook or LinkedIn got hacked because I said that I put 1% of my portfolio into Bitcoin. And people thought that was crazy. And I said, well, to me, it makes some sense to put 1%, because if I lose 1%, it's not going to hurt me. But if the Bitcoin goes up to $1 million of Bitcoin, it's going to help. And so I'm not having a small 1% exposure to crypto. The people who got hurt were the people who put 30, 40, 50, 80% of them on crypto, and then crashes and they're screwed. I think crypto does have a runway. I really do. I think it has a runway, but I certainly wouldn't put a significant portion of my wealth in there. But I don't know how the digital is going to, if the central bank, more to come on that. That it's still pretty
still so early on that.
Yeah.
I think there's more fear about it than anything. I mean, if they shut down the US dollar, like the paper currency, and everything goes to the US digital coin, whatever they're going to call it, it's, I mean, it's like the government taking over people's wealth.
Well, and
Good time to
you
be
know,
in an annuity, if you ask me.
well, I know, and the thing is, you know, this artificial intelligence, that is something everybody should be very concerned about. I mean, we're going to lose a ton of our privacy. We're going to lose a ton of things. I mean, now they can do deep fakes. They could put you anywhere that they want to, compromising, and you weren't even there, but it looks exactly like you were doing that. And that is to me that they can ruin people. They can, you know, do all kinds of stuff. I'm a little concerned about the artificial intelligence as well.
So do you prefer the S&P 500 index or new indexes?
You know, I kind of stay out of that debate because I really leave it up to the financial advisor to recommend. I'll tell you personally, I own some of both. I have some of them in an S&P 500 index, and then I have some in these uncapped strategies, like in index annuity. You know, their newer indexes, are they gonna? Some of them have had really good track records, and then some of them haven't. So I just say it's kind of a buyer beware. But I'm not going to get into the debate of picking which index people should be using.
That's fair. So what are your thoughts on buffered annuities with income riders?
Yes, I think if there's ever been a time for these buffer annuities, these registered index linked annuities, this is not a bad time to do it. Some of them will protect you if the market falls 10% or 20%, or some you take the first 10% loss. But I mean, look, the market's down significantly. So now you got a buffer under the buffer. So I think it's a great time because, see, Paul, we don't know, is the market going to go up or down? I gave you some gloom and doom, but what happens if somebody knocks off Putin and the war ends? That market's going to go up on that. What if China comes out and says, we are not going to invade Taiwan? It's never been in our plans. The market would probably go up. So there are things out there that could cause the market to go up. So you kind of want to have exposure to the market, but at the same time, there's a whole lot of things that could go wrong. So how can you kind of have your cake and eat it too? I think those products are good at that, because you're in that. If the market goes up, man, you get that. But if the market goes down, you've got some protection. And so to me, that's a powerful story. When we're in an uncertain time and you want to have upside, but you don't have downside. I want to make as much as I can make, but I don't want to lose what I've already got. That's what annuities can do.
All right. So here's a traditional question: whole life or index UL?
All right. Well, what I say is this. I leave that up to the advisor as well. Okay. I'm not going to pick personally. I am a whole life believer. I own whole life. I was in AAA mutual companies my entire time in the industry, but I also have some variable life insurance, and that's one that doesn't get a lot of press. But historically, variable life has done the best of all of them, believe it or not. And so and index IUL, that's the most popular policy in the industry today. I'm not against it. I'm just saying, for any universal life, you want to overfund it, because the problem with any universal life is if the fund is down, those costs of insurance goes up, some of the internal costs go up, and those policies can blow up. So as long as it's properly funded, I'm fine.
So how can advisors talk? How would you recommend a client talking to their client right now who is in that either 60-40 mentality or just likes bonds? How do you get them out?
Well, I would use some of these third-party articles that say replace your bonds with annuities, and they got crushed in bonds this year. So they're not going to be sitting there bragging bonds. No, they lost their shirts in bonds. All right. Now I could actually make a little case for bonds now, because eventually when interest rates have to come back down, and they will have to come down sharply at some point, then bonds go up in value. So at some point, bonds will be a very good deal. I just think annuities are just more consistent and more stable.
What are your thoughts on physical gold and silver?
Well, I own physical silver. I think it's fine to be small part of a portfolio, but it doesn't any money. I think maybe some mining stocks that pay dividends might be a better way on gold. At least you're getting paid some dividends while you're holding a miner stock might be good. But I do have some physical silver and gold just in case of a huge emergency, you know. But we saw when there's a huge emergency, nobody's running out to buy gold and silver. They're buying toilet paper, toothpaste, and water. That's what matters when there's a real emergency. So, and guns and bullets, you know, are more important than gold and silver, I think, in really times of battle.
So I'm going to wrap this up as the last question here. What annuity company out there is, I don't know if you may or may not know of this, has a real estate index option in their strategies?
Well, I'm sure some advisors out there would know better than almost variable annuities would. As far as indexed annuities, I would yield to the people who are experts. You know, Cheryl Moore could list off all the companies that do or don't. That's not what I really focus on. I try to, stick to the basics to really help retirees understand what they should. I don't get down in the weeds. I let the advisors do that part mostly.
Okay. All right. So I'll end it with this. And this is your last parting thought on what we just discussed that you'd like people to walk away with.
I just think, if people would have life insurance to go to their kids, they can spend their money. If they have a guaranteed income to cover their basic living expenses, then they can invest the rest and they can sleep at night. It's all about being happy and enjoying retirement. And I don't believe you can enjoy it without annuities, life insurance, and long-term care insurance. I just don't believe you will have a happy retirement without those products in your portfolio.
And I couldn't agree with you more. Tom, thank you so much for being a guest here today and imparting lots of wisdom. Everybody who's on the call today, you will get a recording of this. Overall, Tom, awesome content as usual. Thank you so much. And thank you.
Thank you, Paul. And thank you to everybody.
Yeah, and if you want to know more about Tom Hegna, go to tomhegna.com. A lot of resources there, a lot of good books and material. So thank you, everyone.
Thanks, Paul.
Have a wonderful rest of the week.